Good morning, everybody. Welcome back to the Opportunistic Trader. It is January 25th, and we are getting ready for the Gold Fix with Vince Lanci. You guys have been listening to Vince regularly. He's got a lot of great information. He has over 30 years experience in the market, mostly in macro and metals and trading, so a lot of great information. And, this is the Gold Fix. Vince, take it.
Thank you so much, Mike. Good morning, everyone. Normally, these broadcasts, our audience and our subscription base, our subscribers and people that are interested are looking for active levels for trading, and they're looking for current events because that is the group that we are. Those are the type of people we are, and you're going to get that today, as always. But from time to time, and those of you who know me through the Opportunistic Trader and otherwise, you will hear me when I feel pretty viscerally strong about something, opine about it. And the events of the last 3 days, and if you have followed me on Twitter and in the chat room, you've seen me make some offhanded comments about it. But I'd like to put a fine line and really make a point here in an editorial fashion about why we are, why it would behoove you to, and I say you, when I mean you, I mean you. I'm saying the average investor better really start considering putting some gold in their portfolio. And I'm going to give you the reasons why. So before I connect the dots on that, let me get to the beginning and what's going on in the news. And then we'll go to the editorial part, which I want to talk about. I think it's very important for the future of people who have money in 401ks, who are thinking about retirement, because investors have become traders. And I'll explain what that means in a second. And finally, we'll go through the trading levels for active traders yesterday. So yesterday, gold and silver were range bound as most markets chopped around looking for or seemingly waiting for some shoe to drop. A good shoe, a bad shoe, it's hard to say. The government shutdown continues after both bills from the left and right failed to gain traction. That's not a surprise to active traders. People who tape watch like us know that probably was in the cards already. In the China trade negotiations, notice I'm calling them negotiations now, not the trade war. That is in and of itself a spin. White House advisors made contradicting remarks that the market seemed to roll its eyes at. I mean, Wilbur Ross said, and quite aggressively, he said, "We are miles and miles." That's a quote from a resolution. While Kudlow, who historically has been a good cop or a cheerleader, used the word determinative to describe the next encounter. Now, when you have a person like, quick editorial comment here, if you have to read what people say and what they've said in context. Lawrence Kudlow, not a lightweight. Okay, whatever your opinion of him, he's not a lightweight. But when he says in the past, "I'm optimistic," things are looking good, we're making progress. And the market had in the past reacted positively to when he spoke that way. But the most recent time he said something that way, the market kind of rallied and faded. And he's no dummy. So to come out and say that the next negotiations will be determinative is like me saying, and I'm not saying he's wrong to say that. First of all, I'm not sure determinative is a word. But the point is this. To say it's determinative is to say it's going to have an impact on the market. And I think that's a fair statement for him to say. But we're going to look at the context of all these things. The reason I think the Ross comment was, even though it was the most pessimistic yet, the reason I think the markets do not panic or take it on the chin, in part, is because Mr. Ross has made some other statements implying by some friends of mine in the industry that he is, quote, out of touch with the situation on the ground. And I'm referring, of course, to him downplaying the risk of inflation and the government shutdown. So I think Wilbur Ross is an outlier in terms of how he's perceived by the markets. But, the chances of so take that for what it's worth. The markets really did nothing yesterday. As Larry discussed with us before going on the air, before Mike and I went on the air, the straddle was cheap. The market chopped around. Boom, the straddle was a very good predictor of yesterday's actions in the stock market. In Brexit, keeping it to one sentence, chances of a push back past the March 29th deadline grow as political uncertainty grows. That's all I'm going to say about that. Data today, and by that I mean no data today. Durable goods and non-home sales. I'm sorry, I can't even remember handwriting. New home sales will not be released today due to the shutdown. The only real definitive data we have is on the oil side, and that's the Baker Hughes rig count today at 1 o'clock. I'd like to discuss the events of yesterday. And you see the gold chart up. You see the gold market up there now. I want to put this up there, and if you could just humor my horrible paint. That was actually done in a sloppy way, in a humorous comment on Microsoft's product. But I want you to look at this map here. The map we're looking at is how the government how the world is reacting to the Venezuelan situation. Now, if you're not familiar with the Venezuelan situation, I'm going to get into that right now. But if it's red, you're basically, for all intents and purposes, backing a coup or changing government in Venezuela. If you're in green, you're not. So the situation in Venezuela is, for me, sounding alarm bells. Uh, as a trader and as a risk manager and as a person who puts his money where his mouth is for over 30 years, it continues to diverge from the last time a sitting president in Venezuela was deposed in 2002. That was Hugo Chavez. All right. The warning signs are there. Here's what I'm saying. All right. Step one, the U.S. backs Criado to replace Maduro. Step two, Maduro still. Point two, I want you to connect the dots. That's the theme here. Connect these dots. Point two, or dot two, Maduro still controls oil and thus the military, just as Chavez did in 2002. So that pretty much, if you follow the 2002 script, that ends the coup right there, because you can pay off the generals. And I know this to be true. Here is where the history diverges and where I get a little bit scared. And this is about gold, ultimately. The US and multiple Latin American countries then support what is essentially a coup in Venezuela. Not coup d'etat, not a violent coup, at least not yet, but a coup, right? Mexico, along with the Eastern trade bloc, does not. Then, in the same day, Mexico casts doubt over the NAFTA 2.0 deal that tentatively was agreed to, I don't know, about a month ago. Connect the dots here, folks. Now, if you can't connect the dots, I'm going to do it for you. And here's how it goes. It is a given that the world is increasingly polarizing along East versus West lines over trade. The U.S., a couple months ago, in an attempt to secure a North American trade pact or trade alliance with Canada, the United States, and Mexico, is now in jeopardy of losing it. Mexico is, for some reason, holding out. The destabilization in Venezuela further polarizes the world and can easily lead to sanctions on Venezuela. And sanctions on Venezuela, here's the next dot, will increase the price of oil. Not just increase the price of oil for the world, but especially hit home in the US. We import about 500,000 barrels a day from Venezuela. Why? Because Venezuelan crude, which is a heavier crude, and I happen to know this, Venezuelan crude is used very much in our refined products. So that means no Venezuelan crude during the sanctions means higher gas prices, higher heating oil prices domestically, and higher oil prices globally. Venezuelan is possibly the largest OPEC producer. It would take, and this is where I get scared. And by scared, I mean, this is where I get really careful. It would take a single miscalculation to shatter what civility remains in this world. And make no mistake about it, people. What are the three things that are basically the criteria for us going into a country that is destabilized? One, in defense of the U.S., we view them as a threat. That applies to Iraq. Two, when we went in there, the spread of democracy. It's in our interest to sow the seeds of democracy, right? And three, oil exists. Look at Venezuela. If you're willing to invade Iraq and you're willing to invade Afghanistan, you're willing to invade Venezuela. Number one, it is definitely in our almost our backyard, much closer for U.S. defense. Two, uh, the spread of democracy. It is an ideal opportunity to spread democracy and capitalism because Venezuela is a dictatorship. Say what you want about who we put in charge. The point is, there's an opportunity there to put democracy there and an administration that has neocons around it, whether you believe or agree in their philosophy or not. This is, people, this is the war that the neocons have been waiting for. And what's the third factor that makes us go into a country? Oil. Venezuela is the mother lode of oil. This should sound alarm bells. If you're complacent because of all the chronic crises, let me go through the potential implications for this and why gold matters. What if all these things happened? What if there were sanctions, which isn't growing by the day because you did not have this situation of a split world when we had a coup in 2002 that failed? What if all these things happen? The dollar would likely come under pressure as domestic problems from the shutdown and North American tensions. Think about that phrase, North American tensions, or let's just say American tensions diminish its safe haven status. Where would the world go if the dollar lost its safe haven status through either a downgrade by Fitch, through a chronic uh, 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 shutdown, or through sanctions on Venezuela? Where is the world going to go? The euro? No. The Kiwi? No. This is a small probability of happening. But I want you to understand, I'm not a predictor. I'm a handicapper. And handicappers hedge disaster. And there is a big risk attached to this small probability. And I'm not a prognosticator, but as a handicapper of risk, as a successful handicapper of risk, as a person who has made a ton of money, $100 million for traders, for hedge funds that I work for, and enriched myself in the process by being careful of black swan events. You have to look at the risk now going forward in an increasing fashion as not having a percent of gold in your portfolio. I'm talking about, and I don't like to use the word investment, but I'm talking about hedging disaster here. And what I'm getting at is, if you look at this chart, if you look at this map, I should say, I thought about everything last night, and then I went back to an article that I ghost wrote for a site that was looking for some legitimate content on gold, and I went through it. And the reason I went through it is because I was looking for what the optimal allocation was for gold. And people generally hem and haw and say it's 5 to 10%, and I'm one to say that as well as a hedge against dollar risk. But if you look at the optimal allocation for gold for the last 48 years, it's actually been almost 20%. Now, if you're trying to follow that chart and you're not familiar with these type of charts, this is an efficient frontier chart. And the efficient frontier is where the inflection is on the left, where I put these arrows right here. The inflection is where the uh, uh, the proper allocation for an asset class is where the curvature bends from left to right. And over the last 40 years, the best performing portfolio actually had, according to CPM Group, a 25% allocation in gold versus stocks and bonds. Now, is that right for you? I'm not saying it is, but I'm saying it's a heck of a lot higher than 5 to 10%. Now, after I looked at that chart, I said, if it was like that then, and I'm seeing these alarm bells out here, I want you to think about this if you're over the age of 50, if you're over the age of 60, or if you're just a person with a lot of equity exposure. You need insurance. And buying the VIX or buying puts because your broker tells you that is not necessarily the way to go, because gold, while it's not the perfect hedge for one risk, it is the perfect hedge for all risks. Specialization of risk management is not the way to go going forward, folks. Look, how much insurance is needed? I wrote this about a year ago. That depends on the individual. Most were okay. It should be noted that CPM has historically tempered its own enthusiasm for gold. All right, so you have my comment on that, but you know Insurance that pays. Look at that phrase there. CPM Gold Group believes gold prices will average some 68% higher than current prices over the next 6 years. Now, CPM Group is not just a company I pulled out of my hat. I know them. I know the principal. I know how they operate. Now, using the current average price of approximately $1,300 per ounce in 2018 thus far, that translates to an average price of 21.85 per ounce by 2024. I don't want you to think of buying gold because you're going to create wealth. But if gold does go to $2,100, where's the stock market? Where's the bond market? I'm saying that this is a hedge. This is a hedge for global uncertainty. It may not be a hedge for IBM's problems. It may not be a hedge for this, but I think you're foolish. I'm sorry. I have to say this. You're foolish if you do not have a percentage of your assets in gold. And I'm going to share something with you that traders do every day. Every trader does this. And I think investors, passive investors, wise people thus far should consider this. There's a paragraph titled, If Not Now, When? When a trader has a position, and by trader, I mean a person who is going to hold a position anywhere from 1 day to 1 month, the highlighted area there in blue in italics. At the close of every trading day that a trader doesn't close a profitable position, he is effectively rebuying that position at the settlement price. So if you bought Apple when it was $50 10 years ago, and Apple's trading whatever it's trading, $160, $200, I really don't care. But when the market closes, you are not long from $50. You're long from the close that day going into the next day. Point being, investors don't care about the next day or the day to day. But when you're close to retirement, you care day to day because you're going to need that money. And if we do have an inflationary problem or increasingly likely a global problem, a global crisis, a chronic crisis that could be our own Vietnam in Latin America, you don't want to think of yourself as long from 50. You think of yourself as long from the previous day's close. Every day is a decision to recommit or liquidate our positions as traders. And the older you get, the more you should think about that. The vehicle that remains the most liquid, with the lowest volatility, and the safest preserver of wealth with zero counterparty risk is gold. Same as it ever was. Now, that may sound a little sensational based on how I normally speak to you, but it is not hyperbolic. I'm being very honest when I say this to you, and I mean it. I'll give you an idea. What are other choices? I look into these. I have portfolios of my own, and I look about land. People are saying, "Well, I own land. I don't need to own gold." Wrong. That's a misconception. That worked in the 70s. But if inflation, as opposed to an economic crisis, if inflation were to happen, do you think you're going to be able to tap your home as a piggy bank? Okay, so your home goes to 200% of what it's worth. You know what's going to happen? Bank requirements going to increase the equity you have. Interest rates are going to go up. So you'll be borrowing on your home to buy a loaf of bread at 20%. You're not going to be able to do that. And there's precedent. The precedent's in Argentina, where I've done some work and I've traded down there. They raise interest rates and they make sure you can't sell your home. Land is not a hedge for an inflationary problem, especially when you have cash flow that you need to be positive so you can feed yourself. You can be stock rich and cash poor, or house rich, as the term goes. What about bonds? It is my feeling strongly that bonds would be no help as a wealth preserver. If you were to pull your money out now and buy a 2% CD today, and this is something that Larry and I talk about all the time, retirees are pulling their money out of stocks and putting their money in bonds, but they're going out 10 years on a bond. If inflation goes to 3%, you're losing 1% in buying power. Remember, it took 10 years for the Fed to stop the deflationary cycle despite zero interest rates that we went to. Should we expect any better performance in an inflationary environment? No. The Fed, as well-meaning as they are, as well-intentioned as they are, when they're trying to manage economic cycles, these are people that are basically putting their foot on a gas pedal of a 1970 Chevy Malibu, and the carburetor is sticking. And when that carburetor does pop and open, if you understand cars the way I do, they're not going to be able to put the brakes on inflation when it gets going for some time. Anybody who remembers Paul Volcker knows what I'm talking about. Raise them again, raise them again. We're going to stop this inflation. What I'm saying is gold is liquid, gold is dollar denominated, and it is a hedge for inflation. Look at your bills. Do you not think you have inflation? Pardon the interruption. There are two big risks on the horizon. One is creeping inflation that's being denied. You see it in your bills, one-time charges, service fees, Netflix goes up. You don't think that's inflation? Your local deli raises cold cuts 10%. That's inflation, folks. They may be denying it, but it's there. The other risk, the very real, very small, but disastrous risk is global destabilization in our backyard now. And if that happens, what are you supposed to do? What's going to happen to gold? What's going to happen to the dollar? What's going to happen to stocks? I strongly recommend that you consider owning an imperfect hedge instead of all these financial products that are perfect for a risk that may never happen. Gold is denominated in dollars. The dollar takes a hit for whatever reason. You will be hedged. You will be able to get out. You have no counterparty risk, and you will be owning an unleveraged asset. If not now, when? Because we are on the cusp of possibly something great, but we are looking at a situation that is eroding confidence in the global economy. So that's my stand on that. And I've written about this before. That's typically not our audience, but I think it's time to talk about it because of the dots that I connected in my head. And again, I'm not predicting war, but I'm saying, this country owns arms to protect itself in case of war. I want you to think of gold as your own version of a weapon to protect yourself and to in case of a financial war. So why don't we go to the active levels for trading today? There's a little bit of humor that I had on statistics, and by the way, today is the 25th. Okay, here's some active trading levels. We have these are the technical levels, and I will give you very quickly. I don't want to run too long, even though we don't have much data today. It's 8:24. I want to hold up the roadmap. Uh, Below 1276, I'm bearish, and I will trade this on an intraday trade. Above 1288, I'm bullish. In between those levels, consider if you're an active trader selling between 1285 and 1288, looking for the market to stay in the range between 1277 and 1288 on the high end. On the inside, 1285 and 1279. Gold has really been, frankly, it's been a horrible product to day trade, to actively trade. But conversely, look at how it's behaved in light of dollar strength, in light of the fact that I happen to know emerging markets, emerging economies are selling gold so they can get dollars during this QT phenomena. And by the way, to digress one more time, QT is the removal of dollar liquidity in the world. That makes countries that have dollar debt scramble to get dollars to pay their debts back. That hurts emerging markets. You know what the cure for QT is? When it's done and emerging markets are holding the dollar back, they're all long dollars because they have to pay their debts. That's when you get QE again. That's when the stock market drops to 2000 and we have to do QE. And when I say stock market, I mean S&P. And that's when you get the bad inflation, and that's when gold goes up. But to our trading levels that I've already said, I am friendly to the market above 1285 spot 37 and below 1279 spot 60. But the levels that I will really get into I will be above 1288. I will look to buy this market with the reversal below 1285. Below 1276, which is that blue line that I coincidentally drew there, and laugh at the fact that the market decided to bounce off of it. Below that line, one should consider being very bearish. Below that line, and a bounce back through it, we're back in the range. I want to leave you this one thing pivoting back to the macro. See this line I have up here? This is the 12-month moving average. Oh boy, I don't know what all that other stuff is doing there. I didn't do that. But why don't we just hide it all? Okay. Well, those dots shouldn't be there. I have no idea what that's about. But that is a 12-month moving average. So why don't we go to a weekly and put it there? All right. Why is it doing this? All right. I'm going to have to talk to my programmer here. Okay. The 12-month moving average, which you cannot see at this moment. We'll go to the 4 hour, the 1 hour. All right. These are probably part of the algorithm I have. The 12-month moving average currently comes in at 1267. If you're a person who's considering putting money in gold, and considering putting in money in gold for anywhere from 6 months to 5 years, which I think you should be, especially if you have none and you are on the verge of retiring and you want to hedge yourself against inflation, I want you to understand this: above the 12-month moving average, that's when macro hedge funds start to play. Now, I'm not saying buy it now. I am saying when it's time to own gold, it's going to be a digital thing. It's going to be too late. This market's going to pop $100, $200, and you're going to be scared to buying it, waiting for a pullback. And you know, it's going to be tough. I'm saying that this market will surprise you. And as it goes with silver, silver's a wild card. It could outperform even higher in an inflationary situation, but it's also an industrial metal. There is nothing like gold. Gold is money. That's all it is. You won't hear governments call it money, but that's what it is. And as a fan of Jim Rickards' work, I want to say this: currency wars, which he talked about, they don't work. And currency wars lead to trade wars. Look at history. And trade wars used to work, but they don't work anymore. Trade wars now lead to sanctions. And when sanctions don't work, you get war. I'm not saying we're having a war, but I'm saying, can you afford to not be long gold and not have a hedge for your retirement nest egg in this environment? It's insane. And I have my eye personally as a trader on 5 delta calls going out 1 to 2 years in gold, because the 5 delta call is the option that is the insurance policy or lottery ticket for traders looking for exposure to the upside. Just be careful. It's 8:29. Have a great day. Have a great weekend. Speak with you Monday, and hopefully we'll have a peaceful resolution to this. But I'm going to be prepared for war. And by war, I mean all kinds of war, economic war mostly. Cheers. This is Vince Lanci in the Gold Fix. Next up, Larry and AM Roadmap. Stay with us.